What's up everyone, Jeremy here. Sorry I haven't been around, and I think it's been over a week now, mainly because of 4th of July. I just had my 45th birthday, done a lot of celebrating, a lot of enjoying life, quite honestly. Just want to do a quick video in response to a new subscriber. Terry Marie is starting to invest in dividend stocks at the age of 67. She's asking my opinion about that. I think dividend stocks are the way to go at that age, maybe with a mix of some growth stocks like she says that she has in her portfolio. She's able to put about $4,000 away into the market, which is fantastic. It looks like the majority of the stocks she's invested in is oil. I have a lot of oil as well in my portfolio. The only other thing I recommend is not to put all of your eggs in one basket. I also have a few closed-ended funds, a lot of real estate, and business development companies. For me, a really good rule of thumb is I like to look at like a 5-year chart and a max chart. I want to see that the value of the stock price has not been declining since inception. It doesn't do me much good if the value of the stock keeps going down over the years. Although I have done this a lot, I've also been very fortunate to always buy on big pullbacks. That ensures I'm always having a good stock price average. So a lot of the oil companies are paying, north of 10% annually, and there's quite a few closed-ended funds which are doing the same. But just be careful that you're not chasing yield alone. You don't want the value to go to nothing eventually. There are plenty of stocks also that are going to be paying a bit less, like in the 6% range, that also go up every year, such as Main, Gain, ABR, Good, QQQX, the list goes on. There's so many stocks. Out of all the stocks that I just mentioned, they range from going up about 30% over the last 5 years to a whopping 147% in the case of ABR. Now, I love REITs, Real Estate Investment Trusts. ABR, I cannot recommend enough. I am not pushing any stock on anyone. I'm not a financial advisor. But that being said, they're just under an 8% dividend yield, and they've done 147% in growth over the last 5 years. And during COVID, they did not cut their dividend. So in my portfolio, I have a lot of stuff that's in the 8 to 13% range. A lot of these stocks, though, I'm very confident I'm not going to lose value over time, hopefully. But I also have a good mix of stuff like Main, Gain, QQQX, stuff that's going to grow and still be paying me about 6% annually in dividends. All that being said, I think it's relatively easy, relatively easy, to maintain about an 8% annual dividend yield safely. And it sounds like Terry's doing pretty good as far as being able to put $4,000 into the market every month. She talks about being the cheapest little old lady in town, and I don't think there's anything wrong with being a little cheap. I'm still trying to follow, believe it or not, a $15 a day budget. This is just for fun. $15 is for food and any entertainment that I want. I still love putting the maximum amount that I can back into the market, because every time I do that, I am a little bit richer every single month. And trust me, it feels so great to be retired and know that every single month I get a little bit more income. So I say to everyone, make a budget for yourself so you know where your money is going. Be diligent on looking at the stocks that you're interested in buying. Don't just buy something because you read an article. I've read so many articles that recommend buying a certain stock, and I look at it and it's like, wow, I'm actually going to do a video on this top 5 that I just read about. That the number 1 was kind of shocking. And you can also go to places like, I believe it's dividend.net or dividend.com, and look at the payout history on these dividend stocks to see if they had to cut their dividends, if they've constantly been increasing it. Another great app that I've talked about before is Stockmaster. I pull it up on my phone sometimes so I can just get a quick snapshot of a company, see what it's done for the last 5 years and max, see what its dividend payout is, see who the institutional investors are. That kind of stuff really matters to me. At the end of her comment, Terry was also asking about how to understand balance sheets better? There's really not a quick answer to this one. I would probably have to do a whole nother video on this, and it could be pretty extensive. Just know that on a balance sheet, you're pretty much looking at assets, liabilities, and equity. In a nutshell, you want to make sure that the liabilities are not out of whack to the assets of the company. And if they do have a lot of liabilities, you want to see that they are taking steps in paying that down. And as I've said before, I do like to see good institutional investor names in there. A lot of these big investment companies or banks, they're not going to invest in millions of shares and not have any say in how the company is being ran. So good for you, Terry, for investing in dividend income stocks. I love dividend income stocks, and it's never too late in my opinion, especially if you do some of these other companies that I mentioned earlier, and there's plenty of them out there that pay a lower dividend. And when I say a lower dividend, I'm talking lower than, you know, the oil companies that you're talking about in your that you have in your portfolio. Things like USAC, USA Compression. I absolutely love these guys. I can't remember what their yield is right now because their stock price keeps going up, but it's probably, off the top of my head, it's like between 12 and 13%, which is fantastic. That being said, with the oil industry, I think it's still going to be around for a while, but especially with the new administration, they're doing a lot of things to, I hate to say, kind of kill the oil industry. So like I said, don't have all of your eggs in one basket, and do take a look at some of these growth stocks that are going to be typically higher than the big blue chip companies that you hear about, you know, some of the dividend aristocrats. Yeah, they might, you know, have been increasing their dividend for 25 years or so, but their payout might only be 2 or 3%. And as far as living off of that, you know, it's going to take a lot more money invested to live off of that type of a yield. So some of these 6%ers that I mentioned earlier, a 6% yield is nothing to scoff at, and more than likely these companies are going to continue to go up over time, like QQX for instance. This follows the NASDAQ 100 with option calls and has been increasing its dividend payout along with the price of the NASDAQ 100. It's just above a 6% dividend yield, and it's done about 66% in growth over the last 5 years. So anyway, I'm gonna stop rambling. Just wanted to address, is 67 too late to start investing? Absolutely it is not. But remember, the earlier you start, the better off you're gonna be in the future. So please like, share, and subscribe if you got anything out of this video whatsoever. And if it's really terrible, then you should share it with your friends to show them how terrible it is. So anyway, I will see you guys in a few days. Thank you so much for watching, and I'll talk to you soon. Bye-bye.